Welcome to the Deep Dive, the show where we take a whole stack of expert sources, market data, all that forward-looking research, and really boil it down. We extract the insights so you, the listener, get that massive shortcut to being truly informed.
Glad to be here.
Today, we are tackling, the question on everyone's mind, right? Homeowners, investors, planners. What does the future of real estate actually look like, say, over the next 5 years?
Yeah, it's a fundamental deep dive. For so many people, their home or their investment properties, that's their biggest asset. It represents the largest pool of their wealth.
Absolutely.
So the stakes are just immense. And, to make any kind of sound prediction, we really have to separate the fleeting speculation from the fundamental value. We should probably keep Benjamin Graham's wisdom in mind here.
The weighing machine versus the voting machine.
Exactly. Short run, it's a voting machine, all emotion and popularity. But long run, it's a weighing mechanism. True value, which at the end of the day comes down to the present value of future cash flows. That's what wins out. Speculative bubbles always pop eventually.
I think that's a really crucial frame to start with. We've got this mountain of predictions, right? Covering tech, shifting demographics, complex financial strategies. It's a lot. So we've tried to organize this deep dive into maybe 3 big areas that seem like they'll define the market heading towards 2030. First, there's this huge shift driven by technology, prop tech, iBuyers, smart buildings, all of that.
Right.
Second, the really fundamental changes in where people are living and investing, that whole urban versus suburban dynamic, which feels like it's accelerating.
It really does.
And then finally, we really want to unpack how the successful investors are adapting their financial playbooks, focusing hard on leverage, but also sophisticated tax planning.
And maybe before we jump into the tech piece, grounding ourselves in that financial reality means looking squarely at systemic risk. It's crucial.
You mean like looking back at 07, 08?
Precisely. When we talk about predicting the next 5 years, we cannot forget those painful lessons. The whole subprime mortgage mess, and then the explosion of things like CDOs, credit default swaps.
Right, the complex stuff.
Yeah, it created this situation where the facts on the ground, the housing market was clearly deteriorating. We're just completely disconnected from the prices on those layered bonds.
A massive divergence.
Huge. So the key takeaway for assessing future stability, for looking ahead, is recognizing when financial innovation gets way ahead of transparent underwriting. That's where the danger lies.
Okay, so let's dive into that first big area, the prop tech revolution. Because, this has moved way beyond just putting listings online, hasn't it?
Oh, absolutely. We're talking about an entire digital ecosystem now. It's attracted just enormous amounts of capital, tons of talent, advisors. It's scaled up dramatically in the last, say, 10 years.
And it's fundamentally changing how we even think about real estate assets, how we transact them.
And the goal really is all about efficiency and transparency. These prop tech solutions are becoming, frankly, indispensable tools, especially for the big players, institutional investors, commercial owners.
So, give us an example. You mentioned VTS before we started.
Yeah, VTS is a great example. Their stated goal, quite explicitly, is to become the Bloomberg terminal for commercial real estate.
Wow. Okay. That's a powerful analogy.
Yeah.
A single source for critical data.
Exactly. And think about the kind of intelligence they provide that, the old methods just couldn't match in terms of speed and granularity.
What kind of data are we talking about?
Real-time vacancy rates, super detailed lease expiration schedules across a whole portfolio, tenant health metrics like are they likely to renew, market trend analysis that's generated from these vast pools of proprietary data.
Stuff that used to take weeks of phone calls and digging.
Weeks, exactly. Manual work, countless calls. Now, if you're a landlord, an investor, a broker who's actually leveraging these tools, you get this definitive edge. You can analyze market conditions, anticipate tenant needs way faster than the competition.
Speed of insight.
That's the new differentiator, absolutely.
And that speed, that efficiency, it immediately creates friction with the, let's say, the traditional brokerage model. We're seeing some major shifts there, aren't we? Big tectonic plates moving.
Yeah, the traditional brokerages are definitely feeling the squeeze.
Yeah.
And it's coming from 2 directions at once.
Okay.
So on one side, you've got companies like Zillow. They're pushing hard to get closer to controlling the actual transaction process itself. They want to reduce the consumer's need or perceived need for a human agent just to get basic info. They want to own that digital front door.
Right, control the interface.
Then on the other side, you have companies like Compass. They've raised just massive amounts of capital. And their strategy is different. They're snapping up the top-performing agents.
Focusing on the high producers.
Exactly. Their promise isn't necessarily cheaper service, it's superior service. They aim to weaponize those agents with cutting-edge tech, generous commission splits,
Yeah.
basically solidifying that human relationship model, but supercharging it with technology.
So it's a battle for who controls the agent and critically the tech the agent
That's
uses.
the crux of it, yeah.
Okay, so shifting to the residential transaction specifically, the focus seems to be laser sharp on speed. And that's where iBuyers come into the picture, right? They're a key part of this whole digital value chain discussion.
Yeah, iBuyers, or instant buyers, they fundamentally change the pace of the market. They offer these rapid, sometimes almost instantaneous cash offers for homes.
How do they do that so fast?
Well, they rely really heavily on sophisticated prop tech algorithms, complex models that quickly assess and value properties, often sight unseen, or maybe with just minimal inspection.
But that sounds like it depends heavily on the quality of the data they're feeding those algorithms.
It absolutely does. That's the significant challenge. For those algorithms to be accurate, iBuyers need high-quality, very recent market transaction data, comps, essentially.
And what happens when the market gets choppy or just slows down?
That's the problem. When markets get volatile or transaction activity just dries up like we've seen in some recent periods, the reliability of those automated valuations, the AVMs, can really suffer.
So PropTech's core mission here is trying to solve that data opacity, make valuations faster, more consistent, even in weird markets.
That's a huge part of it. If they can crack that, it enables the iBuyer model to scale more reliably and reduce its own risk profile.
Okay, so technology isn't just changing how we trade properties, it's changing the buildings themselves, how they operate, how they're managed.
Right.
Beyond the transaction, we're seeing this massive tech overhaul with automation, smart buildings, the Internet of Things, or IoT. And it feels like this isn't just about cool gadgets, there's a big environmental push behind it too.
It's definitely a convergence. Financial necessity meeting environmental urgency. I mean, the global push against climate change is real, and it puts building owners, especially those with big commercial portfolios, under intense pressure.
Pressure to do what specifically?
To demonstrably lower their carbon emissions, conserve energy, reduce waste. The cost of not doing it or even just running inefficiently is rising fast. Think regulations, tenant demands, even investor mandates.
And the tech solution involves sensors and data collection, essentially.
Pretty much. IoT sensors, integrated systems, they create these smart buildings that can monitor everything in real time. HVAC, lighting, water usage, security, occupancy patterns, you name it.
But you mentioned something even more advanced before integrating IoT with BIM, building information modeling.
Yeah, that's the next evolution. That combination doesn't just let you track what's happening now, it allows for predictive maintenance.
Predictive maintenance. So fixing things before they break? That sounds like a huge win for managing assets.
It is massive. Instead of just running equipment until it fails or sticking to these rigid calendar-based maintenance schedules that might be wasteful.
Right, changing filters whether they need it or not.
Exactly. The integrated BIM system monitors actual performance metrics. Things like vibration levels in an HVAC unit, weird temperature fluctuations, sudden energy consumption spikes.
And it flags potential problems.
It flags potential failures weeks, maybe even months in advance. So management can schedule repairs efficiently, often during off hours. It dramatically improves energy management, cuts operational costs, and crucially, prevents that catastrophic deferred maintenance that can just kill investor returns.
So these tech shifts, they give a real quantifiable edge to landlords and investors who actually embrace them, who prioritize that long-term asset health.
Absolutely. It's moving from reactive to proactive management.
Okay, let's pivot now. From the digital layer, let's look at the physical map of America, the trends shaping where people live, where they invest over the next 5 years. They seem profoundly impacted by these big demographic shifts. We hear the term demographic inversion thrown around a lot. What exactly does that mean?
Yeah, demographic inversion, it basically refers to this trend we've been observing for, maybe the past couple of decades, where more affluent, often higher educated populations, and this includes families now, not just young singles, have been shifting their preference back towards central cities, towards those close-in neighborhoods.
So reversing that big mid-20th century wave of everyone moving out to the suburbs.
Exactly. Reversing that mass suburbanization trend, at least for certain segments of the population.
What's driving it? Why are cities suddenly appealing again to the very groups that, fled them decades ago?
Well, the underlying causes are kind of historical and industrial, fundamentally. Deindustrialization is a huge factor.
How so?
It eliminated so much of the noise, the grime, the industrial pollution, the environmental degradation that made city centers pretty unpleasant places to live during much of the 20th century.
You mean like the factories, the smoke?
The tenement manufacturing, the coal dust, the just general cacophony and dirt that historically pushed affluent residents out. Cities are simply cleaner, quieter, and frankly, structurally more attractive than they were 50, 60 years ago.
Which enhances their appeal for who?
For upper middle class residents, primarily. People who value culture, walkability, connectivity, proximity to specialized amenities, restaurants, theaters, unique shops.
And you can see this reflected in the kind of development happening in cities like Chicago or Austin or Denver, right? It's not just slapping up apartment building.
No, it's much more curated.
Right.
Developers are focusing on creating these sophisticated mixed-use environments. They're deliberately incorporating trendy pubs, high-end coffee shops, little wine bars, organic grocery stores right into the ground floor of new residential projects, often in areas that used to be purely commercial or even light industrial.
Designing a whole lifestyle.
Exactly. They're catering very specifically to those upper middle class tastes and preferences, making the city feel like a complete residential environment, not just a place you commute to for work.
Okay, but what's the flip side? What's the impact of this inversion on the suburbs, especially those further out? Are they emptying out?
Not exactly emptying out, no,
Right.
but the dynamism is definitely shifting. Those inner-ring suburbs, the ones with good transit and established character, they often remain very appealing, very convenient.
But the further out ones.
Yeah, the growth in those distant, often less transit-accessible, less convenient exurbs, it's noticeably slowed down. In some cases, it's even stalled. The capital, the energy, the new development, it feels like it's concentrating back into those walkable, close-in neighborhoods, whether they're technically urban or inner suburban.
But this success, this resurgence of the core, it inherently brings up some tough questions, doesn't it? About equity, about access.
It absolutely does. And it forces us to confront the, let's say, complicated legacy of American land use regulation, specifically zoning.
Right, zoning. Our sources really highlight how historically it's been deeply exclusionary.
Yeah, the American zoning tradition, especially as it's solidified in the post-war era, it basically created two really firm borders that are still causing major problems today, particularly with housing supply.
Okay, what are those two borders?
First, the strict separation of home from not home, segregating commercial industrial land uses far away from residential areas, sometimes for good reasons, sometimes not.
And the second?
The second, and arguably this has had an even more profound impact on affordability and diversity, was the separation of the detached single-family home from pretty much every other type of housing.
You mean like duplexes, row houses, small apartment buildings?
Like,
The missing middle housing?
precisely, all that stuff got zoned out of vast swaths of American neighborhoods. And the motivation wasn't always just about, managing traffic or sunlight.
No.
Far from it. If you look at the history, the taxonomies for non-residential land use, and even the exclusion of multifamily housing, were often grounded, at least partially, in a desire for class or even racial exclusion.
A fear of outsiders.
A pervasive fear that allowing shops or small production facilities or even just apartments would bring in lower-class outsiders, threatening property values and the perceived social homogeneity of the neighborhood.
And zoning is still mostly a local issue in the U.S., right?
Overwhelmingly. Which means these highly restrictive, often exclusionary principles are baked right into the DNA of thousands of municipal ordinances across the country. And that severely limits the supply of diverse and affordable housing options right when we need them most.
So as cities get more desirable again due to this inversion, the pressure to reform these old zoning codes naturally increases, right? To allow for more density.
Yes, the pressure is immense, but we have to be really careful with that word density. Because, as the great urbanist Jane Jacobs pointed out decades ago, there's a crucial distinction between high density and actual overcrowding.
Okay, explain that distinction. It sounds important.
It's absolutely vital, especially for investors and residents thinking about the next 5 years. The confusion really stems from early 20th century city planners. They looked at slums, which often had both high densities, meaning lots of dwelling units packed onto a small piece of land, and severe overcrowding, meaning way too many people stuffed inside each individual dwelling.
And they conflated the two.
They failed to differentiate. They basically confused density, which Jacobs argued is actually an urban asset, with overcrowding. which is clearly a social problem, a symptom of poverty and lack of choice.
So well-planned density is good, overcrowding is bad.
Exactly. We have to distinguish between density that's well-planned density that actually supports essential neighborhood life, like diverse local businesses, well-used parks, those diverse currents of life Jacobs championed,
Mm-hmm.
and problematic overcrowding, which leads to strained resources, social friction, and decay. Jacobs warned that when planning focuses only on abstract project images or these sort of anti-city ideals, the result is often just loose sprawl, something incoherent and vacuous for anyone afoot, regardless of whether you throw money at mass transit.
So the takeaway for investors looking ahead is seek out markets that are embracing density reform smartly, integrating it well, not just jamming more people into outdated structures or poorly designed mega projects.
That's precisely it. And there's a cautionary tale here, too, that Jacobs also highlighted. It's the recognition that successful diversity in cities can actually be destroyed by the very economic success it helped create.
How does that happen?
If that influx of affluent residents, driven by demographic conversion, simply prices out all the unique, diverse elements, the little ethnic grocery stores, the independent bookstores, the artist studios, the mixed income populations that gave the neighborhood its character in the first place,
Then the neighborhood loses its soul.
it eventually self-destructs, in a way. It turns vibrant, interesting areas into sterile, homogeneous, and ultimately less desirable, less resilient investment locations. Success kills diversity if you're not careful.
Okay, so as this geographical landscape is shifting, the financial strategies needed to navigate the next 5 years also have to get more sophisticated. But the foundation, the bedrock of long-term wealth building in real estate, that seems timeless. Buy and hold.
It is the absolute core truth. I mean, you talk to successful millionaire real estate investors, the ones who've built lasting wealth, and they are religiously focused on finding what some models call quadrant 2 properties.
Quadrant 2, let's define that for the listener.
Right. So imagine a simple 4-quadrant grid. On one axis, you have appreciation potential, low to high. On the other, you have cash flow potential, low to high. Quadrant 2 properties are the sweet spot. They successfully deliver both strong capital appreciation and consistent positive cash flow.
Okay, so good growth potential, and they pay you while you wait.
Exactly. What investors absolutely must avoid, ruthlessly avoid, is quadrant 3. That's properties with low or no cash flow and low or no potential for appreciation.
The duds.
Those are the high-risk, low-reward assets that just destroy portfolios over time. Buy and hold is about finding and keeping those quadrant 2 gems.
And a key thing that differentiates real estate wealth building from, say, just buying stocks is the incredible power of leverage, the ability to use borrowed money to control a much larger asset.
The power of leverage is just staggering, and it's often overlooked by people outside the industry. It's simply the ability to borrow money at a rate that's lower than the overall return your investment is generating.
And lenders seem comfortable with real estate as collateral.
Incredibly comfortable. They view loans secured by real estate as relatively safe, manageable, stable assets. I mean, think about it. This is what allows the average Joe, relatively speaking, to get a $400,000, $500,000 loan with fairly modest qualifications, often at interest rates that are, historically speaking, quite low.
Right. You can't usually borrow $500,000 to buy stocks with just a down payment.
Exactly. This ability to multiply your returns by borrowing against a tangible asset, it's arguably the most powerful engine for rapidly growing personal wealth in real estate. But, as we talked about earlier, it comes with risk. It introduces systemic risk if the underlying asset valuation gets frothy or speculative.
And we have some pretty stark historical examples of what happens when that speculation just completely overwhelms fundamental value. The Japanese real estate bubble in the late 80s, early 90s. That feels like a permanent cautionary tale.
Oh, it's the ultimate example of castles in the air thinking. I mean, by 1990, the estimated total value of property in Japan was something like $20 trillion.
$20 trillion.
Yeah. Now, contrast that. America's 25 times larger in terms of land area. Yet, at the peak of the bubble, Japan's property was appraised to be worth 5 times as much as all the property in the entire United States combined.
That's just irrational.
Completely irrational.
Yeah.
There was this prevailing belief, almost a mania, that property values would simply never go down. When a market gets to a point where the theoretical value of just one city, like the land under Tokyo, is supposedly enough to buy, say, Canada or California, the price is completely detached from any grounding in reality or cash flow.
And that kind of detachment, maybe structured a bit differently, but that same disconnect between price and reality led directly to the 2007-2008 crisis here in the US, didn't it?
It did, absolutely.
Yeah.
But with this added layer of financial complexity that kind of diffused the risk, or rather made it almost impossible to track who actually held the bag.
Right, the CDOs and CDS again.
Yeah, the crisis was rooted in the systemic risk those complex instruments created. Banks, institutions, they were packaging up mortgages, many of them subprime, into these collateralized debt obligations, CDOs, and selling credit default swaps, CDSs, as insurance on them.
And the ratings agencies gave them AAA rating.
Exactly. The agencies wrongly blessed these structures, which led investors all over the world to believe they were buying super safe bonds even as the actual housing market backing them was visibly collapsing.
So the risk was hidden or maybe just ignored?
It was hidden and massively underestimated. The real tragedy was the sheer scale of the unknown risk exposure. You had some institutions with literally $1 trillion worth of CDSs outstanding on assets whose actual market value was maybe only in the billions. Nobody truly knew who held all the exposure or just how deep that divergence was between the financial price on the screen and the physical reality of falling house prices.
So the clear lesson for today's investor, looking ahead 5 years, is that conservative underwriting is absolutely critical. It's the defense against repeating that kind of disaster, especially now with the growth of real estate syndications where people are pooling money.
Couldn't agree more. When investors are putting their money into a syndication, the sponsors, the folks running the deal, they must adhere to strict conservative underwriting practices.
What does that mean in practice?
It means they should determine the absolute maximum price they can pay for an asset based only on factual, verifiable numbers and conservative assumptions about the future,
As opposed
to falling into the trap of stretching assumptions. That means things like artificially inflating your projected rent growth, drastically speeding up your timeline for stabilizing the property, or lowballing your anticipated repair costs. All just to make the numbers work for a purchase price they've already decided they want to pay.
working backwards from the price instead of forwards from the facts.
Precisely. If a deal doesn't make sense based on realistic, conservative numbers, you have to have the discipline to walk away. That discipline is what protects investor capital in the long run.
Okay, beyond just the numbers and valuation, negotiation remains a huge part of real estate. It's a skill that seems like it'll stay paramount, whether you're dealing with a traditional agent, a tech-powered broker, or even an iBuyers algorithm. Are there psychological levers investors should focus on?
Oh, absolutely. We can definitely leverage some classic psychological principles in negotiation. First one that comes to mind is the contrast principle.
The contrast principle, how does that apply?
Well, if you're selling, you can use it to manage expectations. Our sources mention the classic retail technique, right? Sell the really expensive item first, like the fancy suit, because then the price of the accessories, like the shirt or the belt, seems much less significant in comparison.
Okay, so in real estate.
In real estate, it might mean anchoring the price discussion effectively. Maybe you present necessary but costly repairs up front in the negotiation, which can make the subsequent adjustment to the overall purchase price feel less severe or more justified to the buyer.
Interesting. And what's another key psychological aspect?
Understanding and, frankly, sometimes playing to the core fears of the other party in the negotiation.
What are those core fears?
This is often where deals are truly won or lost. For the seller, their deepest, most profound underlying fear is usually not sold. The fear of the property just sitting there, languishing on the market, maybe declining in value, becoming a constant headache and expense.
Okay, fear of it not selling. And for the buyer?
For the buyer, the biggest fear is often not bought. Missing out on what they perceive as a great opportunity, losing the deal to someone else, having to start the search all over again.
So understanding those fears is key.
It is. And one of the biggest mistakes clients or even inexperienced agents make is refusing to even counter an initial offer because they feel the parties are just too far apart. That's often a mistake.
Always counter.
Always counter, even if it's just a small move. Effective negotiation often requires the investor or their agent to strategically, maybe subtly, remind the seller of their wall, that risk of the property remaining unsold altogether if they refuse to engage constructively. Gently playing to those underlying fears is frequently the only way to successfully bridge what initially looks like a massive valuation gap.
All right, let's shift into the practical application of strategy. As the market speeds up, financial tools get more complex. sophisticated wealth management, and especially advanced tax strategy seem absolutely essential for maximizing returns over the next 5 years.
They are non-negotiable for serious investors. You have to leverage every tool legally available. And the bedrock, the absolute foundation of real estate tax strategy, is depreciation.
Depreciation. Okay, let's break that down simply.
Yeah, depreciation is kind of the secret weapon for real estate investors. It's an annual income tax deduction that the IRS allows. Basically, you get to recover the cost basis of the structure, not the land, over a set period. It's 27.5 years for residential rental property, 39 years for commercial.
And the key term people hear is paper loss, right?
Exactly.
Yeah.
Paper loss. You're taking a deduction on your taxes, even though you may not have suffered any actual economic loss on the property's market value. In fact, it might be appreciating. This deduction helps shelter the actual cash flow your rental income generates from being taxed immediately.
Okay, so that's basic depreciation. But there's a more advanced strategy that builds on this. Cost segregation. How does that work? How does it accelerate the benefits?
Right. Cost segregation is essentially an engineering-based tax study performed on your property. Instead of just depreciating the entire building shell over that long 27.5 or 39-year period, a cost seg study identifies specific non-structural components within the property that can be legally classified into much shorter recovery periods.
Like what kind of components?
Things like land improvements, parking lots, landscaping, fences, or specific personal property and equipment inside the building, specialized plumbing for a certain use, electrical wiring for equipment, fixtures, even carpeting in some cases.
And these can be written off faster.
Much faster. These components can often be depreciated over 5, 7, or maybe 15 years instead of nearly 30 or 40.
Yeah.
This dramatically accelerates your tax benefits into the early years of owning the property. It generates much larger paper losses sooner, which you can then use to offset other passive or even active income, depending on your situation.
Sounds powerful, but also complex. Doable yourself.
Our sources strongly advise against trying this as a DIY project. You really need professional, expert assistance, usually specialized engineering and accounting firms, to perform the study correctly. They create the documentation needed to withstand any potential IRS scrutiny. It's an investment that usually pays for itself many times over.
Okay, got it. Now, the ultimate tool, maybe, for preserving capital gains when you move between properties seems to be the 1031 exchange. This feels critical for investors trying to scale up their portfolios.
It is arguably the single most powerful strategy in the tax code for deferring capital gains taxes, potentially indefinitely, on the sale of investment property.
How does the deferral work?
So if you sell an asset, say an apartment building that has appreciated substantially, instead of immediately paying capital gains tax on that profit, the 1031 allows you to roll that entire profit, plus your original capital, into a like-kind replacement property.
But there are strict rules, right? I always hear about the deadlines.
Extremely strict, non-negotiable rules. First, you have to formally identify the potential replacement property or properties in writing within 45 days of closing the sale of your original property.
And 45 days. Okay.
And then you must actually close on the purchase of that replacement property within 180 days from the original sale date, not 181 days.
Wow. Tight timelines.
Very. And furthermore, the entire process, the handling of the funds, must be managed through a qualified intermediary, or QI. You can't touch the money yourself. If you miss any of these deadlines or procedural requirements, the tax deferral is completely voided and the tax becomes due.
So careful planning is essential there. We've talked about investment capital, but what about retirement savings? A lot of people just assume their 401k or IRA has to stay in stocks and bonds.
Yeah, that's a huge misconception and a massive missed opportunity, especially for investors who understand real estate well. They can utilize what are called self-directed retirement accounts, SDIRAs.
Self-directed, meaning you control the investments.
Exactly. This allows investors to take a portion, or all, of their existing retirement funds from an IRA, maybe an old 401k, and invest those funds directly into alternative assets, including real estate.
Like buying a rental property with your IRA money.
You could, yes. Or it could be investing in a private mortgage note, buying shares in a real estate syndication, even owning raw land, all within your tax-advantaged retirement account. You do this through a specialized custodian.
Without liquidating the account and paying penalties or taxes.
Correct. You're not taking a distribution. The self-directed custodian simply facilitates holding these alternative assets within the IRA or 401k. It allows your retirement capital to work directly in the real assets you know and understand, which, for many sophisticated investors, can generate better or at least more predictable risk-adjusted returns than the public markets alone.
Okay, that's fascinating. Let's shift gears slightly to the operational side, managing rental properties. What metrics and management strategies really define success in the market we're heading into?
Operations are where the rubber meets the road. You absolutely have to know your numbers inside and out. Starting with the basics. Gross operating income, or GOI.
Remind us what goes into GOI.
Sure, it's your growth potential rent, that's the total rent if every unit was occupied, and paying full market rate minus your rent loss. Rent loss includes vacancies, any concessions you give tenants, and crucially, bad debt from tenants who don't pay. Then you add back any other income things like laundry machines, parking fees, pet fees, late fees.
Okay, that's the income side. But expenses are key too.
Absolutely critical. Investors must factor in all the operating expenses realistically. Property taxes, insurance, utilities, repairs, and maintenance. But also, don't forget turnover costs, painting, cleaning, marketing between tenants, maintenance reserves for bigger ticket items, and property management fees if you're using a third party.
And underestimating those can sink you.
Quickly, if you underestimate your turnover rate or your maintenance costs, your actual financials will rapidly diverge from your initial pro forma projections. That can turn a seemingly good investment into a cash drain. Accuracy in budgeting is paramount.
And then there's managing the tenants themselves. It's a specialized skill, isn't it? I mean, the old phrase, the customer is always right, doesn't quite fit landlording, does it?
It really doesn't. Not perfectly. While providing excellent customer service, which means being respectful, clear in communication, prompt in addressing legitimate maintenance issues, is absolutely vital for keeping good tenants. The tenant is not always right.
So what's the right approach?
Landlords really need to train the tenant from day one. That means clearly establishing expectations. Here are the office hours, here's how and when rent is due, here are the consequences for late payment. You have to enforce the lease terms consistently and fairly.
Lack of consistency causes problems.
Big problems. It leads tenants to believe that management will be lax, which inevitably results in financial headaches, operational chaos, and disputes down the line. Consistency is key.
And finding good tenants in the first place. Screening.
Screening is everything. Background checks, credit checks, income verification are standard. But the single best predictor, bar none, is getting and thoroughly verifying references from previous landlords. How they behaved in their last rental is the most reliable indicator of how they'll behave in yours.
Good point. Okay, one last area operationally. Short-term rentals, STRs, Airbnb, Vrbo, that market has exploded and seems like it's still evolving fast.
Yeah, the STR market is still heavily reliant on the big online travel agencies. The OTAs, like Airbnb and Vrbo, they provide the platform, the visibility, the booking engine for the vast majority of hosts.
But there's a push away from them too.
There is. There's a distinct and growing movement, often tagged as #BookDirect, where owners try to build their own independent websites and booking systems.
What's the advantage of booking direct?
Well, moving bookings off the OTA platform gives the owner complete control. Control over their cancellation policies, their fees, avoiding OTA commissions, and crucially, they own the guest data for future marketing.
But it sounds harder.
It requires significantly more effort, time, and frankly, expertise. You need website design skills, a marketing budget to actually drive traffic to your site, a system for managing direct payment processing securely. It's a heavier lift.
So for most smaller investors?
Most smaller STR investors will likely continue to rely on the visibility and the relative ease of using the major OTAs. But for larger portfolio owners or those really focused on brand building, developing their own direct booking channel is increasingly seen as a valuable long-term strategy.
Wow. Okay. We have covered a lot of ground today. A really comprehensive journey synthesizing these complex data points across, 3 major fronts?
Yeah, it feels like it.
We've unpacked that collision of technology, everything from the speed of iBuyers to the long-term efficiency of smart buildings. We dug into the geographic shifts, that demographic inversion driving urban change, suburban adaptation. And then we got into the sophisticated financial planning required now, leveraging debt wisely, navigating complex tax policies like depreciation and 1031s effectively.
Right.
It really feels like the real estate market of the next 5 years leading up to 2030 is going to be defined by this intersection of speed, location flexibility, and just intense financial rigor.
I think that's a great summary. And maybe tying it back to that historical wisdom we started with. The market always makes mistakes.
Always.
Always. Whether it's the crazy dot-com bubble in the early 2000s where internet stocks seemed to be discounting profits into the hereafter, or the massive financial crises that followed various asset bubbles, the market gets it wrong, sometimes spectacularly wrong. Real doozies, as one source put it. The enduring lesson, really derived from decades of financial history and reflected in our sources today, is that no single person, no single institution, consistently knows more than the market itself. Your true success, long-term, lies in applying those proven value principles, practicing relentlessly conservative underwriting, and maintaining a really deep, humble understanding of risk mechanics.
That's a powerful closing thought on the market itself. And it brings us to our final provocative thought for you, the listener, to maybe chew on after we sign off.
Okay.
We spent some time earlier discussing Jane Jacobs and her warning, how the very economic success of a diverse, thriving neighborhood can, somewhat ironically, lead to its own self-destruction through exclusion and homogenization.
Right, the success paradox.
Exactly. So given the technological acceleration we've talked about, which often favors efficient, perhaps higher-end development, and this ongoing demographic conversion pushing affluence and investment back into urban centers, here's a question for you. What active, intentional planning must you engage in? Whether you're an investor focused on long-term sustainable value, or maybe a homeowner trying to protect your community's character, or even just a citizen advocating for smarter policy. What do you need to do to ensure that the success and the efficiency gains of the next 5 years don't inadvertently lead to that self-destruction of diversity in your own preferred market? How do we prevent vibrant areas from becoming just economically homogenous, maybe even sterile zones?
It really makes you think about the downstream consequences of today's decisions, doesn't it?
Yeah.
How do the choices your local zoning board makes today impact the actual character, the viability, the resilience of your community come 2030? Something we all need to consider.